it is 4 o'clock now. So I can see people are still coming in. So in the sake of time, we need to start. So whoever is going to join us, that's fine. So this presentation is 1.5 hours. So it's starting now at 4 o'clock and ending at 5:30. So thank you very much for everyone that is tuned in. We really value your time. I know today is Saturday when you're supposed to be relaxing with your families, and we have given this time to come and attend this, this webinar. So there's 3 panelists here. There's 3 people that are going to present, and we are going to give you as much detailed information as we can, but also given the time limit that we have, it's about 30 minutes per presenter. So, you know, property investing is a very broad subject. It's something that we cannot just cover just like that. So we should also be mindful of all our family members, friends, and all other people that are suffering under the COVID-19 pandemic. You know, this is something that has actually caught us unaware, but we have to work with what we have. So, you know, there's no point crying over spilled milk. We just have to rise on and then, you know, start doing the work. So as you can see there, it's myself, Sanders, and I've got Gracious, and then there's Amit. So I am happy gonna introduce Amit to start the presentation. And Amit is gonna talk about himself, but briefly, I have known Amit for a while now. We have been working together. He actually works for Marsden as a solicitor, and clients love him because, you know, he works to his limits, and you know, each time you need him, he's actually there. He specializes in property law. There's a lot of branches within Marsden, but Amit specializes in property law. So Amit, if I can give you this opportunity to, you know, share your knowledge around the property acquisition process.
Yeah. No worries. Thanks, Sanders. Thank you for that introduction. I'll just share my screen. Okay, well, my name is Amit Kumar. So I'm a solicitor at Marsden's Law Group. I'm actually a partner at Marsden's, and I specialize in property law, in particular property development law. So we do all sorts of aspects of law, but my specialty is property development. So I've worked with Sanders for some time now, assisting Sanders with his developments, also assisting Sanders with his clients that do, you know, duplex developments, triplex developments, or even single land developments, or even single house developments. So today I'm going to go through the property acquisition process and sort of give you an insight of what is involved in purchasing property and what is involved in the several steps that are involved. So this is obviously a high level view of the process. There are lots of, you know, small steps in between that we go through once we are, you know, once you come to us and we have your particular matter that, you know, might be unique. But this is an overview of the process. So the first step is prior to exchange. Now, the process for exchange is where a buyer comes and meets a seller, and both parties want to purchase, and one wants to sell and one wants to purchase a property. Pre-exchange is when no one has committed to the transaction. So the buyer is still making his inquiries, and the seller is still, you know, waiting for an offer and acceptance. So the first step is an offer and acceptance. So, you know, the buyer will give an offer and the seller will accept or decline that offer. So pretty straightforward. And normally it comes down to the price. So the purchase price is the main thing that normally gets negotiated in property transactions. If the price is not right, then all the other terms are somewhat irrelevant. So the price is the first thing, offer and acceptance. And the second part of prior to exchange is normally drafting the contract, which is generally the job of the vendor, which is also the seller, so the vendor. The vendor solicitor drafts the contract, and then the purchaser solicitor reviews the contract. So that is the next step. And then certain pre-exchange reports are prepared or commissioned or purchased. Those reports include a pest and building report and a strata report. Now, I'll come down to these reports a bit. I'll talk about them a bit more closely a bit later on. One of the main things that needs to be done prior to even thinking about purchasing a property is to organize your finance. And Gracious will probably talk about this in more detail later, because she's the finance expert in this seminar along the panelists. But finance is very important. You need to first understand, before you even think about buying property, before you even putting any offer in or looking anywhere in any particular suburb, is to understand and appreciate what your limit is, how much you can borrow, whether that is 500,000, $1 million, or 1.5. Once you know what the limit is, and you've got some sort of, pre-approval or some sort of, verbal advice from your mortgage broker or your bank, then you're able to proceed further and understand what type of houses or land you can buy. So they're the pre-exchange steps. So the first step is pre-exchange. These are all the things we do: offer and acceptance, organize finance, and start reviewing the contract. The next step is the exchange step. So that is when, for example, the way I see it is I explain it to clients, it's like a handshake. It's like a promise. Exchange is where the purchaser promises to buy and the vendor, being the seller, promises to sell. Once the purchaser signs on the contract, the vendor also signs the contract, the money is paid, both parties are committed. So that is when the contract has exchanged. So when you hear the word exchange, that means, it sort of means a commitment. So are you willing to commit yourself to this transaction? Now, there's three methods to exchange, right? There's three methods to buy property. So in short, in New South Wales, there's a number of ways in which you can buy property, but simplistically speaking, there's three ways. The first way is with a cooling off period. So that is when you put down a 0.25% deposit. It's a holding deposit. You put a 0.25% deposit down of the purchase price, and you sign on a dotted line, you sign the contract, and now you're committed. However, you've got 5 days or 10 days to proceed further. And you can do your inquiries in that period, and you can pull out if you want afterwards. The second way is with a Section 66W certificate. So a Section 66W certificate sounds a bit technical, but what that means is, in simple language, it means that you do not have any cooling off. So the things that you would normally have to do within the cooling off period, which I'll explain a bit later on the slide, there's a couple of things that you do in the cooling off period, which are normally what we me and Sanders like to call them due diligence inquiries. So due diligence inquiries within those cooling off period, you would have to do that prior to you signing, because in a 66W certificate arrangement, you do not get the benefit of a cooling off period. So once you sign, you're bound, you're legally bound. And the third way is an auction. And an auction is very similar to a Section 66W certificate arrangement. However, the only difference with an auction is that each person attends the auction, normally in person, but these days, obviously, due to COVID, it's happening online. You attend the auction, and the highest bid wins. With a Section 66W certificate, it's still not an auction. It's simply, the agent organizes negotiates with one purchaser, then goes to the other purchaser and tries to make as many phone calls as he can to get the highest price for his client, being the vendor. But in an auction, everyone's there in front of everybody. You know who the buyer is. If someone's competing against you, they will be outbidding you, and you know who they are. Exchange can take place in a number of ways. Now, normally lawyers and conveyancers have always had, and also real estate agents have always exchanged via wet ink. But these days, it's also done by DocuSign, which is an electronic platform to sign documents. Now, in terms of the cooling off period, so as I said, the cooling off period gives you a period of time in which you can make certain inquiries. Now, it's 10 business days for off-the-plan contracts. So off the plan means vacant land off the plan or strata property off the plan. There's 10 days. However, if it's any other property that's not off the plan, then it's 5 business days. So I normally advise clients, even though if you're buying a house of land, established house of land, still try and negotiate a 10 business day cooling off. And I always do it for my clients because realistically speaking, it's very hard to obtain finance within the 5 business days. You should get 10 if you can, if not 15, right? Because with COVID, the banks are delaying everything. And it's very hard to get finance formal approval in that 5 business days anyway. So it's a good thing to think ahead a little bit and get the 10 business days from the outset. One of the things that you do in the cooling off period, so there are 3 things generally speaking. The first thing is to undertake any due diligence searches. Now those searches can be a pest and building inspection and can be a strata report if the house is a unit or a strata duplex. Now, the pest and building report is very important because it tells you what may be wrong with the property, especially if it's an established property, it's been there for some time, like termites or mold. So that's very important. If there's anything that's broken in the property, you can sometimes get the vendor to fix those things. So me and Sanders, as I said, when we get the pest and building reports, we go through them together for all of our mutual clients, and we sit there and look at what things are fatal and what things are not fatal. Now, if it's fair wear and tear, obviously, it is what it is. You can't do much about it. But if there's something fatally wrong with the property, then we can decide whether we want to proceed or not, or we can get the vendor, being the seller, to fix that issue prior to settlement. Or if they don't want to fix it, we can get them to reduce the price. So sometimes we can say, okay, they don't want to fix it, that's fine. Can you shave off $5,000 from the price? And then we'll fix it ourselves after settlement. So that's a negotiation tip that you can use. The second thing you do in the cooling off period is to obtain formal loan approval. So that's the broker's job to do, to obtain formal loan approval. And the last thing is to seek legal advice on the contract. Now it's very important to seek legal advice because you want to know what your rights and obligations are under the contract. And if there's anything that you want amended, your opportunity is those 5 business days or 10 business days. Now, if the purchaser is not satisfied with the condition of the property or the terms of the contract, or cannot obtain finance, or you just don't want to buy the property, you've changed your mind, right? In the cooling off period, you can rescind. Now, rescind means you can pull out. You can pull out of the contract with pretty much no penalty, apart from the forfeiture of the 0.25% holding deposit. So the 0.25% holding deposit you pay at the beginning to secure the land or the house, that deposit gets forfeited. So apart from that, you've wasted your time, you waste a little bit of money, but at least you're not committed to the transaction. So that's one of the good things about a cooling off period. You can secure a property quickly and fast. However, you do get that period to the luxury of time to make those inquiries. Now, again, as I said, with a Section 60W certificate, there's no cooling off period applicable. You must have your finances organized prior to exchange. You must be satisfied with the condition of the property and the state of repair of the property prior to exchange, and must have legal review done prior to exchange. So pretty much everything needs to be done before you sign. Otherwise, you run the risk of, for example, you don't have finance, you run the risk of not being able to settle on time, unless you are a cash purchaser, then that does not apply to you. Auction. Now, auction is very similar to Section 66W. No cooling off period applies. The highest bid wins. So everyone is familiar with the auction process. Essentially, the highest bid wins. So if you get the highest bid, then you win the auction. You obviously have to pay the deposit on the spot. So that's one thing a bit different from auctions to a Section 66W certificate. With a Section 60W certificate, you do get a little bit of time. You can pay it that afternoon or whatever it is as soon as possible. But on auctions, you need to pay it straight away. In terms of the legal review, for auctions, you need to ensure that you obtain a copy of the contract prior to the auction, and that you get your lawyer to review that contract, make sure there's no issues. And if there are any things that need to be amended, they need to be negotiated prior to exchange, so that you're not going to the auction on a contract that is not favorable or that you do not like the terms of. So it's very important to make those amendments prior to exchange. And then when you do that, make sure you engage a solicitor well before the auction day, because there's nothing worse than trying to look for a solicitor the day before the auction and no one is able to help you. So there'll only be very few people who will be able to drop everything and review contracts for you the day before the auction, which normally happens on a Saturday. Also, you must be satisfied with the condition of the property, the state or repair of the property, and you need to make sure that you do a pest and building report. Now, with auctions, the pest and building report, you can do an independent one if you want. However, some agents these days are organizing a pest and building report, a common pest and building report, and a common strata report for prospective buyers to have a look at. Now, the issue with that is that, yep, it gives you a good idea of the state and condition of the property. However, legally speaking, you cannot rely upon that report because it was not commissioned by you and it was not paid by you. So that's one thing to bear in mind. But if you're familiar with the property and you're happy with the property, then you might not want to obtain your own report. Now, the next step. So once we've gone through those, whichever way the property is being sold, whether it's auction, whether it's private treaty, and within private treaty, whether it's a cooling off period or a Section 66W certificate. Once you exchange and you've put forward your offer, the vendor has accepted your offer, you've signed, you've paid the deposit, and now the cooling off period has expired. So you're committed, you've got finance and everything in order. The post-exchange process starts. So that involves paying stamp duty. So pretty much every single purchase in New South Wales is subject to the payment of stamp duty, unless you fall within one of the exemptions, which I won't go through today, but one of the exemptions, generally speaking, are first home buyers. So if you're a first home buyer and you come within the thresholds of buying a house and land package or land within the thresholds in New South Wales, then you will be exempt, or you might get a concession from paying stamp duty. But otherwise, if you're buying it for investment purposes, more than likely you will be paying full stamp duty on your purchase. Now, stamp duty is payable within the earlier of 3 months from exchange of contract or settlement. So whatever date is the earlier date. So if you're settling within 6 weeks, then you'll be paying stamp duty within 6 weeks. However, if you're settling in 6 months, then you'll be paying on the earlier date, which is 3 months. So it's always the earlier of 3 months or settlement. That's when stamp duty is payable to Revenue New South Wales. You also need to organise your finance and make sure that loan documents are signed. So that's when your broker comes into play, and they will be able to organise the bank to issue you documents, and they'll go through those loan documents with you for you to sign them and return them to the bank in time so that they're ready for settlement. And the next step in terms of post-exchange is to order post-exchange searches. These searches are searches such as Transport for New South Wales, Road and Maritime Services, Department of Education, and Endeavour Energy. So these searches are due diligence searches that are done after exchange, and they make sure that there's nothing that's fatally wrong with the property in terms of its future use. For example, the Transport for New South Wales search makes sure that there's no road widening in the future. Now, most times, it comes down negative, but there are instances where it will come back as, hey, there is a proposal for future road widening. Those houses generally are, on main roads or arterial roads. So, you've got your roads such as the Northern Road near Southwest Sydney. You've got Windsor Road in Northwest Sydney. So those roads, houses that are on those roads, they're more than likely at one stage in time in the future will be widened. And the government, being the Transport New South Wales Authority, will acquire land for road widening purposes. The next step is to prepare settlement figures. So those figures are prepared by the solicitor, and they simply say, whatever money you've paid so far, which is a deposit, so the price less the deposit, and then all the adjustments that get paid, for example, council rates and water rates, which gets adjusted on settlement. That's the step 3, the post-exchange process. And the last step is settlement. So settlement is the process by which the purchaser pays the money. They pay the money to the developer or to the owner, and in return, the owner gives the property to the purchaser. So it's almost like a swap. Now, these days, so in the olden days, I should say, so a couple of years ago, settlements used to take place on paper. So it would be similar to a stock market where it'd be like a stock floor. You'd go to the city with your paperwork. The bank would attend. The purchaser solicitor will attend. The vendor's solicitor will attend. Everyone attends and they swap their paperwork. So one person brings a certificate of title. You have all your checks in favor of the owner or the bank if there's a mortgage, and you swap, and then you end up with a title deed with a transfer document. And then you would go to the land titles office to register that document to show that you are the owner of the property. But these days, that process is now redundant. Settlements do not take place on paper anymore. Everything takes place on an electronic platform called PEXA. So PEXA is an electronic platform where everyone joins in. So the banks, the incoming bank, the outgoing bank, the purchaser, and the vendor all join in onto the PEXA workspace, and they nominate a settlement date, they nominate a settlement time, and then at that time and place, on the internet, everyone simply clicks a button and the property settles. Now, sounds very simple, but it's not that simple in practice. I can tell you that much, because there's a lot of things that can go wrong, and when things do go wrong, which is a lot of the time, then it is very important that you have someone on your team from a legal perspective that is in your corner, that can represent you to make sure that the process is as smooth as possible. So normally the banks are the ones that are a bit slow, unfortunately, because they've got thousands of settlements taking place on the same day. But it's always important to have a good mortgage broker, and always have a good solicitor on your team to make sure that the process is as smooth as possible. Now, in the event that the settlement does not take place on the settlement day, then we've got a problem. If the settlement does not take place on the settlement day, then you can do a couple of things. You can either extend the date. So the purchaser can request for an extension. That extension needs to be agreed between the parties. If the extension is not agreed between the parties, then what normally happens is that the purchaser in New South Wales is normally required to pay penalty interest. Now, penalty interest is an interest. It's sort of like a bit of hurt money for the purchaser to make sure that they fasten the process for settlement, because they've been given a normal settlement period is 42 days in New South Wales. Sometimes it's 35, sometimes it's 30, but between 30 and 42 days is a normal settlement period. You can have extended settlement periods like 3 months, and you can have short settlement periods like 7 days and 14 days, but normally it's 42 days. So if you haven't got your finances in order and your, the PEXA workspace up and running in 42 days, then there's a real problem. Then that means that either the bank's not happy with the documentation that's been shared or submitted, or there's some other problem from someone else, and it might not always be the purchaser. It can also be the vendor. The vendor can also be the cause of the problem. They might not be ready to settle, or their bank might not be ready to discharge the mortgage. In the event that the purchaser is not ready, but the vendor is, or the other way around, the purchaser is ready, but the vendor isn't ready, then either party can serve what's called a notice to complete on the other party. So notice to complete is a notice that is served on one party to make time of the essence. So once a notice is served, at that point in time, the matter becomes quite serious, only because after the 14-day period, which is a notice to complete period, the other party can terminate the contract. So terminate means to pull out of the contract, but the money gets forfeited. So it's more relevant for purchasers. So the purchaser gets served a notice to complete on them, which it gets served on the solicitor. So such as myself, it'd be served on myself. I will then advise everyone, hey guys, we've got a notice to complete. At that point in time, from that day onwards, you get 14 days to get our settlement in order. If you don't settle in time, then we simply lose the deposit, and we may be sued for specific performance. What that means is that the vendor can take us to court and sue us for the loss if they suffer any loss, that is. So that's very important to make sure that you settle on time. The last thing that you normally do for a property before settlement is a final inspection. So I normally recommend that purchasers do a final inspection either the morning of settlement or the day before settlement. Now, so the final inspection is nothing more than just simply looking at the property, making sure it's still there, hasn't burnt down, or it hasn't broken down, and to make sure there's no issue with the property, no one's damaged it significantly between the time you inspected the property and between the time you are buying the property, you settling the property, I should say. So that's the last step, the settlement process. Like as I said, PEXA is an online platform, so it stands for Property Exchange Australia. It's an online platform that allows lawyers, conveyancers, and financial institutions to complete settlements electronically. So it provides a single national e-conveyancing solution. So it's very handy these days. It's actually created a lot of efficiency. It's actually very, very widely used. In fact, the New South Wales government has made it mandatory for settlement. So even if you wanted to do a paper settlement, you're not able to anymore. So that was from the 1st of July 2019. It became mandatory. So that's the settlement process. I'll quickly go through, I have a little bit of time. I'll quickly go through the 5 most negotiated terms of a contract. So now when I get a contract, there's a lot of things I look at, but there's 5 main things that I look at and I raise every single time that are probably the most popular items that are negotiated in a contract for sale. The first thing is a deposit amount, right? So the deposit amount is always negotiated. Generally speaking, we always push for a 5% deposit because why would we pay more money than we have to? We can delay the payment of money until settlement. So it's simply a cash flow issue. It doesn't mean that you don't have to pay the balance of the 5% later. It's simply a cash flow issue. You pay 5% now and you keep the other 5% in your bank, and the 10% and the balance of a 10% deposit gets paid on settlement. Most contracts these days, though, the front page still remains as 10%, and vendors do that on purpose because in the event you don't settle on time, they would like to recover the balance of the 10% deposit from you. So deposit is one of the main things that people like to negotiate, especially popular with first home buyers because money can be tight for them. And the next thing is the release of deposit clause. So now, in my view, deposits should be kept in a trust account pending settlement of a transaction, or sometimes people are selling their house and they have to move into another house and buy another house, so they need that money to buy or put a deposit down on another property. So it's also acceptable for a vendor to use the deposit that a purchaser has paid. However, it is only to be used for the purchase of a property or the payment of stamp duty. In the event that it is released simply unconditionally, so if it's released without any conditions, then that could be quite risky, because if it's, say, $1 million purchase, $1 million purchase price, and the deposit is 10%, being $100,000, and you release that money to the vendor gets that money in his bank account. He or she can now go ahead and spend that money. And there's no guarantee that in the event you rescind the contract down the line that you will be able to recover that money. He might go ahead and buy a Ferrari or Mercedes, and there you go. You can't sell that car anymore. And even if you do, you won't get your money's worth back. So that's why it's very important to make sure that the release of deposit clause is dealt with accordingly. The other 3 amendments, so director's guarantee. Director's guarantee is one very big clause that I don't like personally, and Sanders knows this. So if you're buying a property in a company name, it's only relevant in the company name. So if you're buying individual name, a director's guarantee is not relevant for you. But if you're buying a contract in a company name, then normally most vendors will require you to provide a director's guarantee. That means that in the event the company cannot settle on time, then they want the director of that company, being the individual, to be personally liable for the obligations under the contract. So, you become personally liable. It's not a very good thing to give if you have assets in your personal name. So my general rule of thumb is I always recommend against providing director's guarantees, and I will always request for it to be deleted. Now, 90% of times, most vendors will agree to delete a director's guarantee. However, they may require you to pay a 10% deposit. So normally it's a bit of a compromise. You pay 10% deposit, you delete the director's guarantee. If you don't want to pay a 10% deposit, you want to pay a 5% deposit, then most vendors will not agree to delete a director's guarantee. So it is that sort of balancing act, and in that instance, I will always sort of recommend, if you have the money, then pay the 10% deposit. rather than giving the director's guarantee. But it's all personalized because it depends on your personal circumstances and what your assets are. The next thing is penalty interest. So I touched on penalty interest earlier, that if you don't settle on time, you have to pay penalty interest. That is interest calculated daily on the balance of the purchase price. Now, normally interest on most contracts are 10%, so 10% per annum calculated daily. However, due to the low interest rates in the market these days, we normally request for the interest rate, penalty interest rate, to be reduced to somewhere between 6 and 8%. So that's quite normal. In saying that, obviously, we do not want to pay interest at all, whether it's low or high, because we want to settle on time. But so that's the first aim of the game, to settle on time. However, if you do not settle on time, then we should be paying as very little interest as we need to. So 6 and 8% is quite widely used in the market, but most vendors will submit contracts to you with 10%, if not higher. So it's up to your solicitor to make sure that gets negotiated. And the settlement period. So settlement period is fairly basic, fairly straightforward, and normally 42 days. However, you can request it to be longer or shorter, depending on what you personally like. So you want a delayed settlement period, or you want an extended settlement period. So it's entirely up to you. With COVID, I do recommend that you don't go for a short period unless you're a cash purchaser. So unless you've got cash in the bank, try and stay with the standard 42 days. Because the banks do like to take their time to organize settlement. So that's a bit about, that's the end of the legal side of the presentation. I'll quickly skim through a bit about myself. As I said at the beginning, my name is Amit Kumar. So I'm a property development lawyer. I'm a partner at Marsden's. Marsden's is a law firm that has been around for a long time. So we've got around about 150 staff, 6 offices throughout Sydney. So we deliver all types of law. We do commercial, criminal, dispute, family, immigration, injury, property, of course, local government, planning, environmental, and wills and estates. So we do pretty much everything. Anything that you need help in, we are able to help you with. And we've got a fair few offices around New South Wales as well, Sydney, Oran Park, Leppington, Camden, and Liverpool. I'm in the head office at Campbelltown, and that is all about Marsden's. That's about it. So I've got any questions. What we'll do is, I believe Sanders and I and Gracious will answer any questions at the end of the presentation once all the panelists have spoken. But that is, hopefully you've taken some insight and you've learned something today from my presentation, and I'm looking forward to hearing your questions at the end, and hope to see you soon. I'll hand it over back to Sanders.
Thank you very much, Amit. That was brief and to the point. Every purchase that you need, contract exchange is very, very, very important. Without having contracts to be reviewed, then it doesn't make sense. So every transaction, every purchase, you need a solicitor to actually help you around this.
I'll stop sharing my screen now. So Sanders, you can take, or Gracious, you can take over.
Yeah. So I'll take this time to introduce Gracious. So Gracious does a lot of financing, obviously. There's no way you can purchase a property without finance. So finance is step number 1. Without money, you cannot buy anything. So Gracious is the mortgage broker that we use in our transactions. She is very knowledgeable in so many ways, whether you are buying in super, you are buying in your own name, in a company, whether it's developments or anything like that. So she has got a vast experience and she covers pretty much the entire Australia. So Gracious, I'll give you this time to actually come and present.
Good afternoon. I was just about to say good evening. Good afternoon to all our to the hosts and the participants who have joined us on this webinar. Thank you, Amit, for such a comprehensive presentation on the legal side of things, which we often overlook when we get too excited about buying that dream home or getting into that investment purchase. So that's very, very important. So those who don't know me, my name is Gracious. I am the director of Eagle Life. At Eagle Life, we specialize in everything, home loans, investment loans, SMSF loans, business loans, everything loans, anything you can think of that need finance, we are the go-to. And we are digital mortgage brokers. So what COVID has taught us is we're not really bound by jurisdiction. We cover nationwide. So we do loans as far as the Northern Territory, Mount Isa, areas that we've never been. The beauty of what the lenders now allow us to do is we can verify clients using FaceTime, using Zoom, using the digital platform. So we no longer need to actually meet clients face-to-face, which makes things easier, especially during these lockdowns. It means you can still be organizing your investment portfolio without actually leaving the comfort of your home. So what I'm just gonna cover off on this afternoon is the strategies to build a property portfolio. At least we're going back to the basics. So it's not gonna be any complicated stuff, but just some hints and tips on how you can build a property portfolio that's gonna work well for you in the future, and that's gonna help you secure that financial future and financial freedom that you may be looking at. Okay. So a few things that the pandemic has taught us, or what we know about COVID-19 so far. When the pandemic hit at the start of 2020, economists predicted that like a 20% drop in the property market. The opposite happened. We all know Sydney, New South Wales property increased 20%. Victoria, regional Victoria, pretty much there is no state that there was no increase. Even areas that were stagnant for a very long time have seen increases in property values. Interest rates, we know interest rates are relatively low. This is probably the lowest they've ever been since, for a very long time. Pre-COVID, what we know as well is the property market fundamentals were very strong, which is still the same, because at the moment we've got border closures, but at the same time we still have a lot of hype that's going on, and the market is not showing any signs of slowing down. Then what we also know is history repeats itself. We had the global financial crisis around the 2007, 2008. A lot of people who had just bought property that time were very much distraught because they were thinking, what's going to happen? You look what's happening, and they didn't know what the future held. But according to CoreLogic data, from 2006 to 2016, which is the period that covers that global financial crisis, properties in New South Wales increased almost 54% of New South Wales properties doubled in value, and about 44% of Victorian properties doubled in value. Other states, probably not relatively as much, but they were sitting around the 33%. And we're just talking about properties that doubled. We're not talking about the ones that increased maybe 90% or 70%. So to some, the pandemic has been a crisis, but to some, the pandemic has been an opportunity. What we're seeing from our end as mortgage brokers, we've never been busier. People are buying properties like they're going out of fashion. So, which means for some, they're seeing it as an opportunity because as the economists are now predicting again that there's going to be even a 17% more growth in this year. So there are no signs of slowing down in the market. And do I personally think that the market will continue to grow at 20% every year? Probably not. But what I know is even if it grows with a further 10% or further 7%, that's still growth that's happening in your property. And if the market does then get to a point where it softens, remember, there will just be a softening. There's no way we'll drop again by another 20%. The market may soften, yes, but it's not going to decrease by the same rate that it would have grown by. 90% of all millionaires become so through real estate. This is not my words. This is just something that I picked up along the way. A lot of companies, like the owner of McDonald's was asked the other time to say, what business are you in? And he said, I'm not in the business of beggars. I'm in the property business. I just use the beggars to advance me or help me build my property portfolio. Why real estate? So why is real estate so much more, maybe why a lot of people place more value on real estate? It doesn't mean the other asset classes there's anything wrong. There's nothing wrong with other asset classes, but just talking about real estate, we're talking about high cash yield. At the moment, with the way that interest rates are low, we're seeing that we are financing a lot of properties that are paying for themselves. So our investors are buying investment properties that are paying for themselves and also leaving cash in their pocket. And we've got equity built up in the real estate. You can leverage using the same asset, pulling up equity to buy the next one. It's a hard asset. You can see it, it's brick and mortar. You can also have tax advantages associated with purchasing an investment property. So these are the upsides of real estate as compared to other asset classes, although there is no wrong in diversifying and also investing in other asset classes. There are different strategies to investing. Some use buy, renovate, and sell, where they can just get in, do some maybe quick cosmetic renos, and then offload the property. There's some that buy, live, and convert. So they buy it as an owner-occupied, live in it for 12 months to take advantage of the capital gains, or live in it for whatever period, and then convert it to an investment. And then they live in the next one again, convert it to an investment. That's a strategy that works for some. Some use the buy and hold strategy. Some use joint venture deals where they get in as a group or they get in as a family, whatever works for them. Some only buy off-plan purchases. Some also use SMSF as a strategy. So throw a few properties in the SMSF. And I know some that also buy properties based on the yield. So they look at the gross rental yield or the net rental yield. And some would say, look, at the minimum, I don't buy anything that doesn't give me a 7% gross rental yield. That's their strategy that they use. So as an investor, you need to pick a strategy. It's harder to be a jack of all trades. You become the master of none. Better to pick one strategy that you think you can really follow through and focus on and study and really understand. This is not my slide, but I picked it up because it demonstrates what I'm going to talk about. This, I picked it up from Iron Fish. Here it shows the growth over time of someone purchasing 4 properties over a 7-year, 8-year period. You can see that the they purchased the first property in year 0 worth $500,000. They did not do anything up until year 5. Year 5, they purchased the second property. And then in year 7, they did another one. And in year 9, they did another one. And this is assuming a very conservative growth rate of 4.73%. Remember, we have seen this, the market outperform this over the last 12 months. Like we have seen, the market really outperformed this percentage over the last 12 months. But this is just looking at conservative figures only. And this is also assuming like they're not putting any money down, which obviously would not be the case. Obviously, the first property, they would have to put money down. The others, we're assuming maybe they're tapping into the equity of the previous properties. But if you look at this strategy, you would see that by year 10 of this particular person holding these 4 properties, they would have a total net equity of $596,000. By year 15, net equity would be around 1.4 mil. By year 20, that's 2.46 mil in net equity. To put this in dollar terms, I worked out if they needed to save this money on a yearly basis, putting it into a bank account, they'll need to put 130 grand savings in a bank account every single year. There are not many people that can do that, but by purchasing 4 properties over a 9-year period, leveraging on equity on most of these properties, that's why we're skipping years. So from year 1 to year 5, they're building up the equity. From year 6, they can tap into that equity, and then they skip another year or 2, and then they tap into the other one, into the next property and use the equity and still be able to achieve this level of growth over a 20-year period. Rates and fees. So what do we know about interest rates and fees? Like I said earlier, rates are so low. We've not seen them this low before. We're getting rates as low as 1.89% for fixed rates. Some have gone even lower. There's 1.74% fixed rates. Variable rates, you could get as low as 2.29, 2.48 if it's owner occupied. Investment rates, 2.49 variable, 2.69 interest only. We've got a lender that has come up with a 2.39 interest only this week. So rates are pretty low. So you can have a look at these rates and also check if you're not paying too much on your mortgage, because obviously keeping the interest rate as low as possible helps you to then add on to that property portfolio without really feeling like it's making any difference. So the way we look at it is, if a client comes to us, we also review their existing property portfolio just to make sure they're not paying too much, so that we can be able to put them on the lowest rate that then frees up extra cash flow for them to throw in that second or third property without actually feeling like they're holding those many properties in their portfolio. Refinance, we are also seeing a lot of refinances. This is just an example of a refinance and how to maximize on refinances. So I took an example of a 500,000 30-year loan term. This particular client was paying 4.2%, repayments 24445 monthly, refinanced them at a 2.7%. And like I said earlier, rates have become even lower. New repayments 2028, savings 417 per month. If they're to put back these savings into the home loan, so the benefit of the refinance is better putting back the savings into the home loan. So don't use the money for anything else, because you would have paid the money anyway. Put it back into the mortgage, and this person would save 7 years, would reduce the mortgage by 7 years, saving 55,300 over the life of the loan. This is a recent example that we did. We financed, this is an investment property we financed for a client. This is located in Wodonga. Property sits on 739 square meters, positively geared, 4.66 rental return. Clients did not put any money down on this deal. We reviewed what they already had. We had financed another property for them. So we reviewed what they already had in their property portfolio, used the equity to put down on this deal. And the client also qualified for a 10% LMI waiver. That's the deal that's currently running for registered nurses. So registered nurse, you could be eligible for a 10% deposit and no LMI. So they put this 10% deposit. So previously, prior to us having this discussion, clients were just saving money, because then they were thinking, oh, we don't have enough equity in the property to then purchase another investment. But when we reviewed their property portfolio, we realized in as much as they didn't have equity up to 80%, we could take an advantage of this LMI waiver, increase the equity, pull out equity up to 90% from the existing investment property, take out a 10%, put it down on this second investment, and have the clients not be out of pocket. And this is, so they just settled on this deal. They're not looking at doing another one because this deal is positively geared. It's leaving cash in their pocket. So why not look into the next one? So this is some of the benefits of having everything reviewed and taken into account to maximize the deals and the specials that are available on the market. Final tips, start from where you can afford. Investing doesn't have to be very complicated. It doesn't have to take a lot of money. I always say start from where you can afford. Don't go with the Jonas's next door, whatever they're doing. No, do your own due diligence and get a pre-approval in place, preferably a fully assessed pre-approval, so not the auto-generated pre-approvals, and use expert advice. Mistakes can be very costly. So always use expert advice, otherwise making mistakes can be very, very, very costly. So in summary, I would say it is possible to hold a property portfolio with more than 5 or more than 10 properties. I just used 4 as an example. And you don't have to live on baked beans and toast every night. If you've got the right structures in place, if you've got the right team on your side, they will make a lot of these things easier. They'll make things easier in giving you the right type of advice, and also advice on where to buy, which type of assets to buy, and things to look out for. So I would say that that's me in a nutshell. Our tagline is financing every dream. So there's nothing too hard. We look into everything, and as long as you've got the dream, we'll get the finance sorted. And like I said earlier, we do service nationwide, and no loan is too small, no business is too small for us. So thanks, guys. I'll leave this time. I'll hand over this time back to Sanders. But thank you again for tuning in this afternoon.
Thank you very much, Gracious. So the tip of the day is, obviously, a mortgage broker has got all the lenders at her disposal. So for me, I'll never walk into a bank looking for a loan, because the mortgage broker knows it all. So they can, look at different lenders, tie my situation exactly to what I need, instead of me walking to a single bank that will just, accept me as I am. Instead of giving me what I want, they're actually going to sell their services to me. So we actually learn every day. And guys, you can put as many questions as you can as you want, either in the chat box or you can put in the question and answer. So for the sake of time, we are going to go through all the presentations, and then right at the end, we'll go through all the questions to actually try and answer them. So this is the only way you can actually learn. This platform is free. This platform is for all you guys to actually use. So do not be scared of asking questions. There's no stupid question, okay? We are all learning. So having said that, I will now, it's now my turn to present. Right, so obviously I'm gonna introduce myself. So my name is Sanders, and I run a business called MSISA Property and Consulting. So my story is quite very long, but for the sake of time, I don't have enough time to talk about my story. People already, those that already know me, I basically am a migrant, like most of us. I came to Australia in 2004, and I came here as an employee. So I have been working as a registered nurse. That's what actually brought me up here. But I realized that, you know, being a nurse is fantastic. The job is quite solid. You can, you know, you can get the job pretty much anywhere, and it actually pays very well. But I was looking at what the future holds, and I was looking at what retirement actually looks like. So being a nurse is good. You can, you know, buy a nice home, raise your family, buy a nice car, and then most of the time we work so hard and there's nothing to actually lean on when we actually get into retirement. So today we are just talking about basics about investing. You know, I don't want to talk about a lot of jargon. I know in this group, there could be people that own more investments, but today, please allow me to just talk as if we are all starting from scratch. So whatever I'm gonna say today is not financial or legal advice. So you need to seek financial, or you know, you actually need to contact the right people to actually advise you. So as I said, my name is Sanders, and I've been a nurse most of my life. And this is when I was in Zimbabwe back home. I was working as a registered nurse, and that is my wife there. So I thought, no, something should be done, and this is what I did. So from giving injections, I went into construction. So I started investing into property, and that's what I'm actually doing right now. I have left my job entirely to do this, and I've left my job entirely to help other like-minded professionals or people that actually want to invest. So, like anything else, without planning, you cannot get anywhere. I'll give a simple example. If you want to buy a Mercedes-Benz, the first thing you think of is actually seeing the Mercedes-Benz parked in your driveway or in your car garage. So if you don't plan visualizing that Mercedes-Benz, there's no how that you're gonna actually buy it. So you can see it, you can smell it, you can see yourself driving it, and you can see your family in there. So this is the same with property investing. So you need to start with a plan. So without a plan, you are just dreaming. And then once you have that plan, obviously you need to then set goals. So setting goals is some of the things that I didn't know what people talk about when you are talking about setting goals. So you need to know where you want to go. So then when you have got those goals, then you need to set deadlines. There's no point setting a goal without a deadline. So I've realized I'm buying that Mercedes-Benz. when am I going to do it? So there should be a date to do that. And what does it look like owning that Mercedes-Benz? What does success look like? So you should visualize yourself having bought that investment property. You should visualize yourself being a landlord. You should visualize yourself with money coming through if it is a positive cash flow property. And then you need to have the right mindset. So without the right mindset, again, you need to make calculated investment decisions. So if you decide property investing is what you need to do, then you need to say, yes, this is what I need to do. There will be distractions. There will be people pulling you aside. There will be so many things, stones thrown at you, but this is what you want. This is the car that you want. So no one will actually stop you doing it. And remember, investing is not about emotion. So emotion is when you're so excited or you see a neighbor driving a nice car, then you think, oh yes, I should have that. So that is called emotion. So investing is not about emotions, it is about numbers. So just visualize yourself having succeeded already. Do not fear to do these things. And the most difficult part that puts us where we are, the majority of us, is procrastination. So this is when you continuously, delay to do things. You always come up with multiple excuses. It could be as simple as saying, my wife doesn't want me to do this. I don't have enough money. This is not the right time. Or the market is falling down. There's COVID-19. So we come up with all these excuses, and this is the most dangerous killer that actually it makes us never do anything. So the other thing is, if you want to succeed, you need to seek help. You can be a professional in your own field. You can be an accountant, but that doesn't mean that you've got the knowledge to actually start property investing. So you need to seek help from people that actually know how to do it. And as we discussed earlier on, without money, you are just dreaming. So where then do we start? We need to have good money habits. So most of the time, I have had situations where someone says, when I graduate being a nurse, this is what I'm gonna do. And then they graduate, they do not do that. And they say, okay, I'm gonna do masters. Probably I'm gonna do better. And then they do the masters, still nothing happens. I've seen people earning less money progressing in life, and those that earn huge sums of money do not progress. Why? Because there is no planning. And unfortunately, the more money you earn, the more you actually spend. So without a plan, you're gonna be living on a paycheck. So money needs to be saved. So if you earn $300 a week, make sure at least you save $100. But if you see yourself spending everything and then without any money saved, then obviously there's nothing that is gonna happen there. So you need to have very good budgeting habits. As I said, you need to spend less than you earn. Money is one of those things I can't really explain much. It's like, we can't do anything without money. Like it or not, money is always an avenue for whatever we do. Talk about driving, talk about going to school, talk about food, talk about holidays, anything, everything is actually money. So why then don't we learn how to actually manage it? And credit cards are some of those things that I've seen people posting that I've got 20,000 credit card. But my question is, do you really need it? Because that's not your money. And then people defend themselves by saying, well, but it is actually paid off. even if it is paid off, it is not your money. When you go to the bank to approach the bank to get a loan, the bank will calculate that credit card debt, sorry, the amount of credit card that you have as if it's money that you have already spent. Because to them, they're asking themselves, what will stop you spending that credit card money tomorrow if a problem arises? So you can live off your debit card. If you need a credit card, that's okay. But do you really need a $20,000 credit card? You know, so credit cards is some of those things that actually damage our lives. Delayed gratification. So if you want to succeed in life, sometimes it's better to forfeit some of these things. You know, do not follow what other people do. I've seen people who work so hard during the year, they raise $15,000 and go on a holiday and actually spend it all. And then they come and work again, accumulate the same amount of money, go on a holiday again, or they buy things that they can't afford just to show off, or maybe to show other people that they are driving a nice car. But in reality, they do not sleep at night because you still need to go and work and make repayments for that car. So delayed gratification means that only spend money on things that you can afford. Do not just do things for the sake of because someone is actually doing it. So if you are a nice child and you can't raise enough money, you know, try and live with your parents for a while and actually try and save money. I've seen this happening a lot, and I don't know what our kids are actually gonna do without, because property values keep on growing and salaries do not go up. So you need to come up with a method of how you can actually save money. Or you can seek promotion or get a second job. It's just a temporal, but if you really know what you need to do, if you know what you want, the best way you can do is it's just a short-term setback. But if you can seek promotion, make sure that the extra money that you earn from that promotion is actually saved. And if you need to work a second job, let it be, but it's not forever. And then Gracia has touched on equity. You know, I've seen so many people, like if you bought your home 2 years ago or more than that, the chances are that you've got a chunk of money sitting there. But if you talk to people and tell them that, you know, you've got $500,000 sitting in your as equity in your home, they will say, well, I can't use it because I want to pay off my mortgage. But then to repay a mortgage takes anywhere from 25 to 30 years. So if you are 25 now, that means that you'll be 55 by the time you finish off that home loan. And you've got one house that you live in. So that means you start investing when you are 55. Unfortunately, property investing is not a quick rich scheme. It is one of those things that when bought well, when planned well, is over a period of time, maybe 10, 15, 20 years. So if I were you, I would rather take that 500,000 instead of owning one home. I use that 500,000 to buy another 5 properties. That way, in that time frame, I'll be having 5 properties versus having 1. And then I can sell 2, sell 3, pay off my mortgage entirely, and then maybe have 2 or 3 properties that are financially unencumbered. So that means I can live off the rent from those properties. So equity in your home is a very, very best way of actually starting and doing purchasing properties. And if you have got other investments, that you bought, they could be equity again. If you bought them for 300,000, probably now they've grown up to 500. So you can reach into that 200,000 and then start buying. The more of these assets you buy, the better for your future. I don't care whether you are 20 years or 50 years. If you don't plan for your future, nothing will actually change. Sometimes we think that, you are energetic, you rely on your job. Unfortunately, that will not last. So you need to plan for your future now. I would rather work so hard today and end up with a better retirement. And as we said, you need to get family help. Sometimes it's a matter of talking to your parents to say, this is what I'm planning. Unfortunately, I only have got $20,000. Dad, can you come up with another 15 so that I can jump into the property market? If your parents really love you and they can see the passion in you, they will definitely help you because they can see that you have got a vision. And I'm not saying it's bad to have shares, but the people that have got money sitting in shares. Property is one of those secure investments where, it is risky, but it's not as risky as shares. So some have got money sitting in crypto. Crypto has done so well, but I don't know whether that will last. And it just fluctuates, it goes up and down. So maybe if you've got money there, you can get that money and actually invest it. So you can swap your share portfolio for property investments. And I love super. Super is one of those things that people think that it's super money, so I can't touch it. So it has to remain there. And then I can only touch it when I am due to actually retire. But the government is giving you that opportunity to invest that money because they realize that they can't look after you when you actually retire. So they gave you the opportunity to create your own self-managed super fund, and you can invest it in any way that you actually like. So we are talking about property here. Obviously, that self-managed super fund will be set up to buy an investment. If you can look back from whenever you got employed, if you have got $200,000 sitting in your super today, it might have taken you 15 years to actually accrue that money. But if you buy a property today for $300,000 and that same property grows to $600,000 in 10 years, I don't think your super would have done that if you leave it where it is right now. So the super really offers better retirement options, and the interest rates that are, when you make profit in a super fund, in your own self-managed super fund, the interest is 15% compared to 30% when the super is sitting in the mother super fund. So we talked about joint ventures. So again, 2, 3, 4 people can come together to put their super together if your money is not enough to actually start investing. So join like-minded investors to put resources together. So from this conversation today, start looking for people that are interested in property investing. Start the conversation, start talking. You'll be surprised, the amount of interest and people that you actually get. So we are sharing the risk and we are magnifying the potential. Obviously, if I've got 100,000, another person has got 100, that's 200. If we are 3, that's 300. If we are 4, that's 400. So that means we can do more. So the other strategy is, so at MSISA Property and Consulting, we only deal with positive cash flow. So this is a long subject, but I'll just try and simplify it. So this is when you buy properties that pay for themselves. So meaning that the rent covers every expense you can actually think of, and you may remain with a bit of cash in your pocket. So the extra money that you get, you can then use it to buy more properties. So that's what I'm talking about, positive cash flow. So we try and avoid negative gearing, which is the opposite of positive cash flow. So this is when you buy an asset to lose money. So you are just stuck there. You may buy one investment and that's it. You never move. And then you'll be praying every night to make sure that your property grows up in value, which might not happen. So investing is a numbers game. It's not about emotions, as I said. I've seen investors who walk into a property, the first thing they stand in the kitchen and they look at the kitchen. If it doesn't look all right, they say, no, I'm not buying this. They visualize themselves living there. Investing is exactly the opposite of that. So positive cash flow will help you leave your job. Negative gearing will tie you to your job. If you love your job, that's good. But if you don't, then that's very unfortunate. So now I'll quickly run into to show you what you can actually do in terms of investments. So for our clients, we don't care. You know, we are all different. So we have got people that are buying small cars, and we have got people that are buying very big, expensive cars. So what I'm saying here, we have got investors that they've got very low budgets. That's what they can afford. As Gresha said, you have to start where you can afford. You can't be copying other people. So the deals that I'm going to show you here is about where you are today and how far you can actually stretch. So do not think that investing is for people that are millionaires. We all started there and we need to start somewhere. So this is one of the deals. If you look at that house there, there's nothing fancy. You know, someone will say, why should I buy that? Well, I won't live there. This is an investment. There's someone who requires to live there. And this asset will grow up in value if actually chosen well. So this was bought last year in 2020. It was bought for 240,000. I know in Sydney, we are looking at probably 800,000 plus to purchase a property. And it was sold this year. This person didn't have money. They wanted to make money. So it was sold this year for 330. So within 12 months, this is what they walked away with. So I remember talking to them, they had $40,000. That's all they had. So now they will get their 40,000 back plus 90K. That's a lot of money to be made. This is another cheap one again. It was purchased last year and it was bought for $230,000. This one did very well and the resales were just out of the world. They walked away with $155,000. This property just settled yesterday. So imagine making $150,000 in 12 months. I don't know how long it actually takes you to save $5,000 let alone. So we deal with a lot of clients that looking at different opportunities. So that same client that made $155,000, they are taking their money and this is what they are buying. So you see, they were buying something for 230,000. Now they are moving into better areas and they are buying better assets. So this is purchased for 450, is actually settling next month. And the weekly rent is 560. So it doesn't look appetizing. It doesn't look okay when you look at the picture there. But it's 2 units joined together. It's a 2-bedroom and a 1-bedroom. So the 2-bedroom is 330, the rent per week, and the one bedder is 230 per week. So together is 560. So if you look at the purchase price there, it's an annual rental return of 7%. So we are not asking too much. The figures are not too extreme. So this one is a positive cash flow deal. So this client is buying in a self-managed super fund. You know, they want a property that pays for itself, and then they grow their super. And at the same time, they rely on capital growth. So purchase price is 480,000, weekly rent is 560, and annual return of 6%. So then, now, so this is what I'm telling you. So I started from the smallest deal and I'm actually going up. So just to show you that it doesn't matter where you are in your investment journey. So this client is after capital growth and they just after income as well. So we purchased this property for them. So if you can have a look here, this house is a house and a grand flat. So on the left, this is the entrance to the existing house. And then on the far right is where the grand flat is. So purchase price is 855 and the rent is 780. Annual rental return is 5%. This one is in a very high growth area. They're looking at capitalizing on that. So now we are getting more sophisticated. This is another deal of our client. They're buying in super again. They want to maximize their money. So purchase price is 1.5 million. And the rental return is 900 a week, which is an annual rental return of 4.5%. They are buying this at 70%. So obviously, the chances are that this loan will be repaying itself. So these are some of the properties that I thought I actually show you. And for the sake of time, I will quickly talk about our services. So as I said, MSISA is entirely there to help professionals that are completely busy. So most of our clients are in the medical field, obviously because I've been working there myself. And they could have the knowledge and expertise, but they have no time because they're at work, they want to invest, but they don't have time. So then they engage our services to research these properties. So, you may look at 1 or 2 properties over the weekend, and it might take you 5 or 6 months to find an investment. But for me, I look at hundreds and hundreds of properties every day and in different locations. So it actually saves a lot of time and money. So we do a lot of planning, a lot of research. We work as a buyer's agent, obviously, and we can advise. So we sit down, look at your situation, advise you accordingly, depending on what you want to be done and where you want to be. So we can look at assets that you have, whether you need to, get equity out of your own home. So we can also look at that. So we work with a number of professionals, as you can see. We have got mortgage brokers, financial planners, solicitors, accountants, anything that is needed in that proper transaction. So it's like something that is done for you so that you don't have headaches. So obviously we have been talking about this. Now it's up to you to actually take action. You can learn, you can do this, you can read books, you can do whatever you like. That's fine. But if you don't take action, things will never change. It's like someone who wakes up every morning to watch a favorite TV show. Nothing will change. You are watching the favorite TV show until you realize that you are losing time. You stand away and do something about it. Otherwise, nothing will change. If you think that someone will wake up tomorrow morning and throw money on your table, that's not going to happen. No one can push you. You just have to make it happen. So, the other thing I didn't mention is that to offer to give back to the community. I've suffered so much for all these years. I've made a lot of mistakes, bought the wrong investments and all that stuff, lost money. But I never gave up. This is what I wanted, and I wanted to build that property portfolio. I was trying to sleep at night. I was always thinking, what is tomorrow gonna look like? What will happen when I can't work or can't, go to work anymore? So I chose property investing as one of the strategies, and I nailed it down, got all the education that I needed, but now I am trying to give back to the community because I see so many people suffering. They want to invest, but they don't have that time to actually do that. So if today you think that investing is some of these things that you need to do, I've got a book coming through next month, and this book is dedicated to our clients and anyone else that wants to be a property investor. So this book is called the 10X Property System. It's about the systems that I've used myself to acquire 15 properties in 10 years. So this is all packaged there for you. And then if you read that book and finish it off, you'll be ready to buy your first investment. So you can see there it says from a registered nurse to a multi-million-dollar property investor. So this is the dream that I had, and is the dream that I have actually achieved. And I'm there to give it for free to you guys. So those that have registered to this seminar today, and they are willing to take their steps, the first 5 people, I am going to put a link in the chat box. The first 5 people that will register to get this book, you also get a complimentary $400 discount on your first property purchase. So but to qualify for this, you need to make sure that you are ready to actually invest. And then along with that help will be that $400 discount plus a free book that will actually be given to you. So I'll put that in the chat box as we go. But for now, I think we have done very well for time. If you want to keep contact, you want to get hold of us, these are our contact details. It's either you go onto the website, MSISA Property, or my personal website. You can actually, if you want a free 45-minute consultation, you can go in there and actually book. There are slots. I'm actually very busy, so you have to be mindful of that. You may not get a slot in the next week or 2, but if you want to book, that's where you actually go to look for that. You can also join our Facebook page, and we are also on LinkedIn. So I'll stop sharing here, and then we'll try and get into the questions if ever there are any. So the questions in the question and answer, and there is also questions in the chat box. Precious, can you see the questions?
Yes, I can.
Do you want to start going through those while I'm setting up this other stuff? Okay,
so I'll just read the questions. So the first one is, does the 10% deposit LMI waiver applicable to all banks, lenders? Someone was saying it's only for doctors. So this one, I think I can answer that one. I think that one is for me. So the 10% LMI waiver began in 2020 when lenders just wanted to reward. Previously, yes, it was only applicable to medical doctors and accountants and other certain professions like psychologists and the like, solicitors. But now since 2020, they extended it to apply to registered nurses / the registered nurses are also falling into essential services workers. So yes, it's applicable to nurses. We're doing a lot of deals. We're seeing nurses buying 4 properties at the same time, saving as much as 50,000 or 60,000 in mortgage insurance. So yes, that's applicable to nurses and not only to doctors. However, this deal is not applicable to all lenders. It's only being offered by certain lenders. So would obviously have to review your specific scenario. There are only 2 main lenders that are participating in offering this deal to registered nurses. The majority of the lenders are still restricting to doctors and other professions. So hope that answers your question. The next one, can I cross-collateralize residential investment security with commercial security for a loan to purchase commercial land? This one is a little bit too specific in terms of what you are trying to do, cross-collateralizing a residential and a commercial property to purchase commercial. So you can't, there are a lot of do's and don'ts when it comes to commercial and residential. Commercial requirements are purely different from residential rates. There could be ways that you could tap into your residential investment to then fund the commercial purchase, but they can't be crossed. There are different products that apply to commercial, different requirements for commercial and different requirements for residential. Then the next one is, hi Gracious, please explain how exactly the releasing of equity on an existing mortgage works for a second or third property, and also what is leverage. So leverage is basically just using what you already have. So like Sanders also touched on this, that you've got one property that has grown in value. So equity is basically the difference between the current market value of your property and the loan balance. So for example, you bought the property for 300,000. The property is now worth 500,000. Your loan balance is 200,000. That difference, which is the 300,000, is the equity. So using equity is pretty much pulling up that increase. You can either pull it out as cash to then fund the next purchase. Hopefully that makes sense. So equity is the increase in the home loan. So the market value less the loan balance, that's where your equity sits. So leverage, it means just leveraging on that increase or pulling out that equity into your as cash and using it as deposit for the next purchase. So the banks can allow you to use the increase in your home loan to then fund another purchase. So equity is that increase that we're talking about that you can then leverage on or take advantage of to then purchase a second or third property. So you can potentially, depending on how much equity is in your property, you may potentially purchase a second or third property without you actually putting any cash down. But something to also think about or bear in mind, equity is the increase in your home loan. So let's say we said the home loan is now 200,000 and we need 100,000 to purchase the second investment. We pull out that 100,000, that the home loan will increase by that 100 that we have pulled out. So that will increase to 300,000. But then we put that down as a deposit on a purchase for 500,000, which means our loan balance on the 500,000 will actually be 400,000 in simpler terms. Hopefully that makes sense. Then the other question is, I think I'll leave this one to Sanders. Is this a right time to enter the market for an investment property, or it is time to wait for another 6 months to 1 year? I think Sanders, you could potentially answer this one.
Yeah, look, that is a very fantastic question. Property is one of those things that is around research. If you rely on the media, if you rely on what you hear or see on the news and whatever people say, it is very scary. You never start investing. So for me, I just look at the fundamentals. I just look at the research that I do. So there's no right or wrong time to actually invest. The more you sit on the fence, the more you lose. Like properties will never wait for you. I've got a person that had a loan approved for 400K. He said, no, I'm not buying now. There's too much chaotic situations happening. I'm going to wait for another 6 months. That 400K loan now, you can't buy anything. It has moved up to 700 within a period of 3 months. So, you know, for me, as long as you do the right research, there's no right or wrong time to actually invest. Like right now with the COVID-19 that is going on, people thinking that the world is actually coming to an end and they are putting their heads in the sand. This is the right time to actually invest, and we are investing massively. I don't know if I've answered your question. The more you wait, the more you lose.
Then another question here again that you may answer whilst you're at it. Sanders, you talked about positive cash flow properties. Is that interest only repayments or principal and interest?
It can be both, dependent on your situation. But for investors, we encourage them to pay interest only, so that you have more money to actually use on buying more assets. But if you want to make it P&I, which is principal and interest, is there as well.
Thank you. Then the next one is there a limit on how much accessible equity one can access? Will banks allow you to use, for example, 600,000 K equity, no questions, or with no contract of sales? Maybe I can answer this one. So with regards to banks, what they allow is there are some lenders who would allow you to do a cash out up to 300,000, no questions asked. But obviously up to 600,000, they would need to see a contract of sale or contract of sales for them to fund that, because then they're doing that increase, but they also, when you are going above the 300K mark, most would want to see at least evidence of the contract of sale, but there's no limit in as far as how much you can tap into, as long as you've got the equity in your properties. Then the other question I jumped up here was, thank you, how long does it take to get a pre-approval once you have a deposit? A pre-approval is very straightforward, it takes anywhere between 7 to 14 days, depending with lender. It doesn't take that much long at all. Hopefully I've answered all the questions on this one. I'll check the questions on the chat to see if there's, I think there are other questions on the chat, and then I'll read it out to you, Sanders and Amit. Okay, someone is, can I have Sanders' book, please? You saw Sanders' email, book a free consultation, and then he'll give you the book. And then the other question is, sorry, there are a few questions up here, so we'll try to answer them as precise as we can in the interest of time. This one is saying, how much do you need in equity to buy the next property? Again, that's dependent on the purchase price, and that's dependent on what sort of deals that we can maximize at the time. If a registered nurse, that may mean you may get an LMI waiver and you only need your 10% plus your stamp duty. So there's no hard figure on there. It's just it's just dependent on the purchase price of the property and how much funds you need to complete the purchase. The next one is, what is buying using SMSF or something? So Sanders, can you answer that one? What is buying using a self-managed super fund?
So that is simply when, I'll take an example. So your money could be sitting in First State Super, or it could be sitting in HESTA, and then you then go and create your own super fund. So this is what we call a self-managed super fund. So then all that money in First State Super or HESTA will be transferred into your own super fund. And then that is called the self-managed super fund that you can then use to borrow and buy investment properties. I don't know if that is as simple as I can simplify it.
Okay, the next question is, does a director being a guarantor affect his or her personal borrowing capacity? Amit, do you want to answer that one? So this is someone asking in relative to giving a director's guarantee. So they're going into a purchase, a company purchase, and they're giving a director's guarantee. They're saying, does that affect their personal borrowing? Or maybe if you can also highlight maybe some of the risks or things that they should be aware if they're giving a director's guarantee.
So in terms of director's guarantees, we need to understand that there's director's guarantees that can be given under different documentation. So you can give a director's guarantee under a contract, which I will obviously advise against giving a director's guarantee under a contract. And also you can give a director's guarantee under the finance documents, so the mortgage documents. So the director's guarantee under a contract, that should not affect you at all. That's simply in terms of your borrowing capacity, I should say. It does affect you in terms of your personal liability, but in terms of borrowing capacity, it should not affect you because under the contract. In terms of a director's guarantee under the finance documents, I'm not too sure whether that affects you in terms of your borrowing capacity. That's more of a finance question, more than a legal question. But all it means from a legal perspective is that if you're not able to pay back the loan to the bank, then the bank can come in and personally sue you for the assets that you have in your personal name. Now, as I said, I'm not a big fan of giving personal director's guarantees under the contract. However, most lenders, most banks will not give you finance if you do not give a director's guarantee under the mortgage. So we got to understand there's two different documents: contract, which is between vendor and purchaser, and then you've got the mortgage documents, which is between lender and borrower. So under the contract, we shouldn't give a director's guarantee, just pay a 10% deposit. Under the mortgage documents, ideally we don't want to give a director's guarantee, but most lenders will require a director's guarantee and will not lend without it. Whether it affects your personal borrowing capacity, don't know. That's more of a finance question. But from a legal perspective, if you're giving personal guarantees in any capacity or under any document, then you need to be 100% sure that you are able to pay the relevant money back in time and that you don't default. If you do default, then the bank can come in and personally sue you for your assets.
Okay, thank you. Another question maybe that you can answer whilst you're at it is, when do we consult a property lawyer when purchasing a property? I think you touched on that, maybe this participant.
Yeah, so there's 4 steps, as I said. Pre-exchange is when you should engage a property lawyer. You engage a property lawyer such as myself to look at the contract before you exchange. You can give an offer in, but that's not binding at this stage. So as long as it's also important to not engage it too early as well. So if your offer for your price is nowhere near what the vendor is wanting, then there's no point wasting anybody's time. So it's important to have someone ready to go. So you're not looking for a lawyer at that point. Have someone ready on standby. Similarly, have a broker ready on standby. But make sure that your price is somewhere within the ballpark. If you've got somewhere in the ballpark of a price, then absolutely engage the lawyer as soon as possible. Especially in an auction scenario. In an auction scenario, you need to engage a solicitor as soon as possible before the auction day, and hopefully not the day before the auction, because then that makes it a rushed job. So a week before, 2 weeks before, as soon as you can, really. But make sure that firstly you like the property, number 1, and 2, that your price and the vendor's expectation of the price is somewhere in the ballpark, that you're you don't get yourself in a scenario where you're wanting to pay 1 million and the vendor wants 3 million. So you don't want that scenario, and you've wasted everybody's time in that scenario. So hopefully that answers that question.
Thank you. I have a home loan, but I have moved out of the house and they've now rented it out. Is it a must to change the home loan to an investment loan? Yes, you need to change it to an investment loan. If you don't, it means you cannot maximize on your tax and negative gearing benefits. because obviously when you go to your accountant and they're going through your statements, they'll see that it's still an owner-occupied home loan with an owner-occupied product. So you need to change it to an investment loan. And then the other question, what are your fees for the investments you are presenting? I think this one is directed to Sanders. What are your fees for the investments you are presenting?
Yeah, so before I answer that, so I have actually put that link where you can book for that to get that special offer. So coming to my fees, it's really very hard to talk about my fees now, because as you saw from my presentations, there were good clients purchasing very cheap properties to properties that are very high. So my fees are dependent on an individual, is what we are actually discussing, what we are buying. Is it in your own name? Is it a super fund? Is all those, it will take forever to actually discuss that. So every client situation is actually different. So my fees are paid at around that.
Thank you. What would you recommend buying first between a residential property to live in or an investment property? There is no right or wrong. You could buy an investment first before your owner-occupied home. You can buy 10 investment properties as long as you never live in them. When you buy the 11th one as your owner-occupied home, you'll still be eligible for your first homeowners grants and concessions. That is correct, isn't it, Amit?
Correct.
Yes. So let's go to the next one. I'm a nurse and I already bought and had to pay LMI. Can I refinance to remove LMI? No, if you've already bought, then you cannot take advantage of the LMI waiver. Maybe it's something that we could look at for your next purchase, or if you wanted evaluation to then see if you could again increase up to 90% for the current one, and then tap on another 10% for the next purchase. Hi, Sanders, what sort of courses are recommended to start in property investment and development? Start with Sanders' book, but Sanders, that's your question. What sort of courses do you recommend to get started?
Look, property investing is a very broad subject. As you can see, there's so many ways of investing. We can talk about this the whole day. Practically, up to now, I've spent almost $100,000 on education alone. So there are so many investment groups. There are so many educational groups, either online or you can attend like COVID-19, you can't do that now. There's no face-to-face. But there's so many investment courses that you can actually attend either online or subscriptions. Or if you want, after COVID-19 finishes, you can then attend live courses. Again, it depends what you want to do. Some courses offer renovations only, some courses offer developments, some courses offer a myriad of things, like all combined together. So maybe that subject is really very hard to answer, because for now, I think I've done almost 7 different courses, so that becomes very hard.
Sorry, just to go back on the previous question, so about first-home owners and whatnot. I'm not too sure what was discussed, but just to clarify, if you buy an investment property as a first-home buyer, then in New South Wales, you lose your exemption or concession when you buy a principal place of residence. So for example, if you're a first-home buyer and you buy an investment property as your first property, but you're not going to live in it, so you buy it for investment purposes, then you don't get any first-home owners grants or any first-home owners concessions. You simply lose that ability to claim those exemptions, and then you move on with life. However, if you buy a new home or a block of land as a first-home buyer, as long as you are within the thresholds, which I won't go into, as long as you're within the thresholds, if you move into a property, or if it's land, you build on the property and you move in, and you live there for 6 months continuously within the first 12 months, then you get the grant or the certain concession. After that period, you by all means, you can leave and you can vacate and you can turn it into an investment later on after you've satisfied the requirements of the government, and you can turn it into an investment. However, if you choose to make an investment from day one, then you lose the exemption. You will not get the stamp duty concessions, and you lose that forever in the state of New South Wales. So that's why it's important to sometimes, some investors, when they want to buy and they want to get into the market, it's sometimes a sensible thing, if you can. Obviously, everyone's circumstances are different, that you may want to move into the property for that small period, get the exemption, get the concession, or whatever it is, get the grants from the government, because it is quite substantial. It could add up to around about 30,000-40,000 worth of grants, depending on what type of property you're buying and what type of area you're buying in. So that's also just to clarify on the grants in New South Wales for stamp duty purposes.
Okay, sure. So Victoria is a little bit different.
Yep.
Victoria, as long as you never live in the house,
yeah,
you're still eligible for the exemptions.
Right.
So you buy an investment today, you never live in it.
Yeah.
When you buy your owner-occupied home, you'll still be eligible for your first homeowners grant and
Right.
the first owner concession.
Right. Okay.
So yeah, it's a little bit different to New South Wales. So that's why I wanted you to check with you.
Maybe Gracious, whilst Amit is still there, there's a question there that says, do you use first home buyers grant if your first property is an SMSF in New South Wales?
No. The first time owners, you cannot be a company and be a first time owner. You have to be an individual.
Okay, thank you. Moving on with the questions. Is there any benefit to paying in more on top of the monthly premiums than what is required for your mortgage? Yes, there is, especially if it's your owner-occupied home, because your owner-occupied home is a non-tax deductible debt. So the more you put in it, the better. But for investment-wise, if you hold two assets, an owner-occupied home and an investment, you'd want to pay more on your owner-occupied home than on the investment. Because remember, the investment, you can deduct tax on it, but you can't do that on your owner-occupied home. The next question is, how can you pay interest only versus principal and interest? What is the difference, and who decides whether it's interest only or both? So this is now talking about structuring the loan structure. So obviously you need a mortgage broker to review your situation, your financial situation, recommend a product that's going to help you achieve your long-term, short-term, and medium-term objectives. And this may include recommending an interest-only loan versus a principal and interest, or recommending a principal and interest. So this is the discussion that you have at the stage where now the loan is being structured. There's no right or wrong, but obviously different products work for different scenarios. I've seen you in a few videos elsewhere. Sanders, will you be definitely contacting you? Gracious, is there a fee for your service, or it's funded by the financier? So we don't charge any fees. We get paid by the lenders. Amit, do you help with setting up trust structures for asset protection?
Correct. We can set the trust structure up, but normally it's set up by the accountant or the financial planner, but we can also assist.
Okay, Sanders will definitely be contacting you for a consultation and to look at my family's portfolio and brainstorming strategies. Then the next one was, Sanders, please share your website link.
I've actually shared it multiple times. I don't know if it's not showing.
Okay, it's not showing. Maybe you may need to share again.
It's actually right there. I've shared it again. So I'll put it once more for the last time.
All right.
Yeah.
Are there any ramifications with the bank if, say, you buy an investment property and then 1 month later you decide to move into the house?
No. Apart from the treatment of the loan, because the bank will obviously give you a certain loan for investment purposes and a certain loan for PPR, principal place of residence. But apart from that, there's certain interest rates that are more attractive for PPR than the investment loan. But otherwise, there's no real ramification. unless you've made certain declarations to the government that you will be not using the property as your principal-based residence, and you lose that on the grant, at which point we then have to do a reassessment of the stamp duty in New South Wales, but otherwise, not really, no.
Okay. Do you recommend buying a property as a trust or as an individual?
That is a question for financial advice.
Yes, correct. So we don't have a financial planner. You would need to speak to your financial planner. There are different recommendations for different things, but we're not, without reviewing someone's financial situation, you need to speak to a financial planner to know if a trust structure or an individual would be the way to go. Can you get the first homeowner's grant plus or have the home under a family trust? I think you answered this, Amit,
yeah,
and
so,
you said
yeah, so
no companies or trusts.
no companies, you gotta have individual, yeah.
Do you all have a recommended financial planner? Yes, we can recommend a financial planner. Sanders, have you got maybe Sanders may have another one. I'll leave Sanders to wrap up and everything after I've gone through all the questions. Link to the book is not showing. Sanders have put a link there. Could you please share in the chat box? I'm looking at SMSF and I have a very small equity of about 50K. As I just purchased 4 months ago, but I have already saved 30K. I have super and can get in touch with in terms of how to go forward. Again, you may need to book an appointment to go through your specific scenario, Lindell, because this may be specific in terms of what you may need to do and what you may not need to do. Sanders, over to you. I think I've gone through all the questions. Feel free to go ahead and answer any, if you've got any additions to the questions we've gone through and any final remarks.
Yeah, look, this has been a massive presentation and I love when people ask questions. It shows that they're keen to move forward and keen to actually move on. Touching base on the question of financial planners, in my presentation, I pretty much said we have got every single professional that you need in a property transaction. So be it a financial planner, a solicitor, a mortgage broker, you know, all that type of stuff. It really depends on the advice that you want. Then we will always find someone for you to actually go to. So maybe the first point of call will be either maybe myself or maybe Gracious, depending on what it is. Then we can always lead you in the right direction. So I think in the interest of time, thanks very much, Amit. Thanks very much, Gracious. Thanks very much, everyone, for attending this event. And you'll be seeing these events so often. Sometimes we like live events, but because of the situation that we are in, that's why we actually hold on to these Zoom seminars. So please watch on for this and stay safe. And hopefully we'll be free next month if we all behave ourselves. And please remember to plan for your retirement. There's no right or wrong time. You just have to start, and you have got all the professionals you need to start your journey. So there's no excuse. Excuses will never send you anywhere. Thank you very much, and bye-bye.